Hey traders, welcome to Charts and Coffee. Happy Monday, everybody. We are taking a look at the beginning of a shortened week. We'll be dealing with the bank holiday on July 4, and then the very next day, we've got non-farm payroll. And if you caught the Top Tier Outlook show yesterday, we took a look at the different events that we'll be dealing with. We've got Powell on the schedule this week. We've got ISM data, manufacturing and services. We've got JOLTS tomorrow. So we have a lot of data that we'll be dealing with, mostly in the employment bucket, mostly looking at the current state of job openings and new jobs from last month. Of course, jobs are relevant because the Federal Reserve has a dual mandate, and that means they're, while not as putting as much emphasis on jobs as they are inflation, both those things have to be within their metrics. In other words, the way that I've sort of streamlined it in my mind is they want to obviously keep inflation going higher without the risk of upending the employment picture. So as long as jolts are, so that's where we are very interestingly sitting. If jolts are disappointing, if non-farm payrolls disappointing, that is going to keep the expectations for rate cuts higher, right? Because it reminds the Federal Reserve, we might be bordering on too high for too long. We're hurting jobs. So this is still an environment where poor, disappointing, bad jobs numbers is actually bullish to equities. All right, speaking of bullish, I am, period, right? No hedging, no storytelling. I'm bullish. I have been for a long, long time. We've had periods of macroeconomic impact where, especially through April, where about 2 to 3 Federal Reserve members, instead of talking about rate cuts or even holds, started mouthing off about rate hikes. And that completely made April about the most confusing month that I have seen in a very long time. It wasn't as if it tanked. It wasn't as if this was a major sell-off. Those are actually easier to trade. It was just sheer choppiness because the market was for 3 months thinking, all right, we're going to see rate cuts. And then a handful of Fed members, yeah, Bowman, I'm talking about you, start talking about rate hikes. And it wasn't until Fed Powell came out at the next meeting and said, rate hikes aren't on the table. If you read between the lines, shut up, hawkish members. And we've been seeing the uptrend resume since then. May wasn't bad. June was quite bullish. And we'll see what kind of month July is going to present us. So then we also want to step back and say, how's that sell in May and go away doing? Not so well, because it just ain't true. So let's stick with what we've got. Now, a lot of folks want to ask me about the election cycle. Don't care, right? A lot of folks want to ask about geopolitics and potential. Gang, we have an uptrend, right? So all the things the market, look, and attention is finite. I remember learning this in motorcycle racing school. Attention is finite. And this comes straight from the book that we used during the class was Twist of the Wrist by Keith Code. And he said, imagine your attention is a dollar bill and you have either 10 dimes, 4 quarters, 20 nickels, 100 pennies, however you want to break it down. Your attention is finite. Our attention is finite. The market's attention is finite. There's only so many things that can grab its attention and therefore move price and volume and volatility. And right now, those other, frankly, more bearish factors just aren't in play, right? They just aren't. Now, might it slow down the uptrend? Maybe, right? Might it make higher highs a little bit more difficult to come by? Maybe, right? But let's stick with the trend, because what the trend is reflecting is not what we think, right? You or I. It's what, generally speaking, is influencing market behavior. And that's something that I'll tell you what, it's one of the most basic concepts around trading. Trade what you see, not what you think. The other thing that I hope I can get across this summer, and when folks ask me about what's going to happen in a year or 6 months or where's it year going to end, and I always ask them, what's the typical time frame that you trade? I'm on a 30-minute chart. And then it just frankly hurts my head. Does a 30-minute chart even care where we'll be at the end of the day or the week, right? So remember, when you're looking at stories, make sure that timeline and the timeline of the trade are actually on the same plane of existence. And that's where a lot of traders will turn the television on. It's nonstop politics, mute it, right? What was the head? I turned for today for hoots, for giggles. I thought, let's turn on the television. You know what was being discussed? That Hello Kitty, yes, I know. I like to call him Hello Kitty. Hello Kitty's buying Chewy. Really, that's financial news. How about talking about volume, volatility, whether or not there's sector participation in the S&P, what stocks, what sectors are leading the S&P, where could it be vulnerable if certain stocks or sectors get weak? Heaven forbid it's actually useful information, right? We're going to talk about Hello Kitty buying Chewy. And then a 2-minute discussion about the cost of dog food. That is what's on social media. And that was within about 10 minutes of my turning it on. And then I had to turn it off so I could, my brain could stop going into whatever happens when you turn on television. So again, I could care less about what Hello Kitty is going to do. What we do want to know, right? Let's say that brings everything to the surface of conversation. And John, I just noticed you mentioned that. John, I don't care. You shouldn't either, right? What we should care about, number one, we don't know what price he bought it at. We just know that he bought it, right? I'm sure that GameStop worked out so well, right, for everybody after that. So again, why we care what this individual is doing is beyond me. However, what is important is that we have an uptrend. So that's where it's interesting, right, John? That's where it's interesting. And this uptrend's been in place since May 31st. This actually makes some sense. There is an overall trend. I tell you, I use it, and the service is excellent. It's very good shipping. It's very good choice. I kind of call it Amazon for pets because it's just that good. However, until the trend is there, right? We're above the 200. We have green candles, and this is an entire month that this has been moving higher. So I don't care what's happening broadly, especially with an individual like that. It still blows my mind that anybody cares. That said, what is an entry price that we can take advantage of? So there's two things we can do, right? Clearly, we're curious. I get it, little cat killer curiosity. But what we can do is look back at the last quarter, right? So I'll just anchor this to April and ask myself, where has most of the volume been, right? If you look back to April, most of the volume is sitting down at $15, $16, right? That's where the most, if you want to think about it, that's where people dug their heels in. If you move it out to May, that point of control is still $16. You move it out to June. Now that point of control starts to move higher. You can see it's about 22, right? So what I want to know is, where's that volume? Where is the participation? And if I'm looking a little bit more near term, somewhere between $21 and $22. Why does this matter? Because those are levels from which, rather than traders, for example, let's say most of the position was built at $30. That's where the late money is in, okay? They just chased it higher. Good for them. However, what we want to ask ourselves is, if we start sinking below 30, what are those folks going to do? They're going to dump their shares and create more selling pressure. If we get down to maybe 28, 20, 25, 80, we get down to maybe 22.70, we get down to the point of control since about, as you can see here, what is this? Mid-May, we're down to about 21 and a half, right? So now we have to ask ourselves, where are the largest group of traders losing money? Because if it's a small group of traders and they bail on a long position, it's going to create a little bit of selling pressure. But if a larger group is hit with, okay, now we're starting to lose money, and they bail, think of the selling pressure that accompanies more size, right? So that's where we want to remember that this is where, gang, the movie title was right. Dumb Money. Anyone see the GME, the GameStop movie? That's about the best title, So now Dumb Money is absolutely coming in. And we were talking about the dumbest of the dumb. Yeah, so now we say, John's going to say, how do I take advantage of that? I'm with you, my friend. How do we take advantage of this? But remember, I'm a terrible poker player. I have no experience, nothing. I'm a dumb poker player. It makes me really tough to play because you don't know what I'm going to do. I remember the first time I played poker, it was at one of the simpler trading tournaments. I did really, really well because I had no idea what I was doing. I played dumb poker. So someone with experience going, there's no way she would do this or that. And I did it because I didn't know any better, right? So imagine that at scale. Dumb money is tough to track. They're always going to buy higher highs. They're going to have diamond hands and whatever else. It's tough to understand what they're going to do, which is why I try to stay away from, this kind of environment. But Chewy is a legit uptrend, but it could have a whole lot more odd action because, frankly, there's going to be now an influx of it adding to, I would say, smart traders who bought dips along the way above, say, $20 and bought some sort of reversion or retracement, whatever they're looking for. Even what happened on Friday, getting down to about $25 and change, great level, right? Great level. So now that we have more attention, it's not the kind that we want. Yeah, in any way, it is not the kind that we want. So still very viable. I love that it's a great trend, but be careful because now the nonsense is going to start to make its way in. And that's unfortunate. I'm all for retail participation and I'm all for someone encouraging people to have better retail participation. But this kind of crowd is very uneducated and they have no interest usually of getting better. They just want to do their Reddit, I don't know, thing. Yeah, Rag, you're harsh. It's just the way that it is. And it's going to make probably a pretty good looking stock a lot more difficult to trade. So when things like this happen on Thursday, we've got to be extra careful because after that, Friday give us just about a mean reversion. I like the area of support right around from a price perspective, $24.78 to about $25.50. But again, depending on where you want to anchor that volume profile and you're looking for size, right? You're looking for size. And remember, if size levels falter, that's going to be that much more downward pressure. So that's another thing to keep in mind. All right. So next up is, let's see. So thank you for the question. That's a discussion and that's a conversation that needs to be had more often, right? There are groups of educated traders, which clearly I'm talking to, and there are groups of uneducated traders that are trading because some dude that they don't even know tweeted. Right? So it's a fascinating game that we play. All right. Next up is, let's go take a look at what's going on with ES as we get closer to the bell. Or not. There we go. So a little heavier than I'd like. I'd like to see S&P stay above 55.32, 55.33. We want to see the NASDAQ move higher. I have a vested interest in the NASDAQ moving higher. On Friday, when we had the sell-off into the close, I bought quite a bit of tech. I like the trend. There are things that I like in the S&P, but they're all things that it shares with the NASDAQ. So remember, the S&P really isn't a great index right now. It's coattailing the strongest index out there, which continues to be the NASDAQ. S&P is a lot of tech, then it's financials, healthcare, energy. Well, those three sectors are not doing great. So when we think about why is the S&P keeping with the NAS? Because of its overwhelming weighting in tech. So why not just go into where the trend is the least diluted by sectors that are not performing? So I do have quite a few long positions built on Friday on the end of quarter sell-off that we were waiting for a little bit of profit taking, arguably some sector rotation. We're going to keep an eye on crude oil. We're going to keep an eye on oil services and energy going into this week. I do like this narrative, mostly Schlumberger and Occidental. Let's keep that in mind, and we'll go from there. I don't like John. Yeah, thanks for asking. Yeah, thank you for asking the question. I think it's a great question to ask. You're kind of walking that tightrope, which I can totally feel it. Rag, on one hand, I don't care what this kitty dude does, but on the other hand, is there a legit trade there? And unfortunately, I'd rather it would have been sans the kitty dude and then kitty litter and more focused on, hey, this is a legit uptrend that up until recently was probably moving in a rather normal way. So JP Morgan, yeah, as far as where JP Morgan is sitting, when I look at JPM, there are two stocks that I'm even vaguely interested in financials. I don't like them right now as a general group, but JP Morgan, Bank of America, and Citi are about as lukewarm as I'm going to be with that sector. I don't like that sector right now. They're just a handful of stocks. And that's one of them that I'm okay with. All right, that I'm okay with. All right, next up is, can the SPY SPX make a meaningful push higher in Q3 when NVIDIA looks poised to continue its pullback? First of all, the first day of Q3. I have no idea what's going to happen in the rest of Q3. Could it? Anything can happen. Let's talk about trends. And why are we focused on the ES if we're talking about NVIDIA, right? NVIDIA is weighted in the NASDAQ heavier. It's weighted in semiconductors heavier. It's weighted in XLK heavier. Remember, S&P is not a tech heavy, well, I shouldn't say it is tech heavy, but it's not a tech only type group. So anything that we're looking at in S&P, that means XLK and SMH have to overcome what's happening in financials, have to overcome what's happening in healthcare, have to overcome what's happening in energy. So if I want to make a play on NVIDIA, it's going to be focused on the NASDAQ, right? If S&P, let me back the NVIDIA part of your question out, Jay. If I'm looking at the S&P, what I want to see is, you're absolutely correct. I want to focus on the long side of those strong names and sectors. However, for the S&P to really participate and maybe even excel in a way that's even better than NAS, we need participation from the other sectors that are not about NVIDIA and Apple. Right? We need participation in sectors like financials and healthcare and energy. Right? Even any two of those three, even any one of those three would be great. But right now, all S&P is just a wannabe NASDAQ. Right? It's just a wannabe. Right? NAS is moving higher, and the part of the S&P that's weighted like the NAS is able to benefit. So if I'm looking at what S&P is going to do, regardless of NVIDIA, I need participation from those particular sectors, right? I don't care about what market internals are doing. Market internals are just a very interesting, fun, make-believe land of imagining that every stock in the S&P or the NASDAQ or the NYSE matter. They don't, because we all know that high concentration weighting rules the trading verse, meaning a very small number of stocks dictate what the indices are doing. A very small number of stocks dictate what a sector is doing. And yet traders are still, thinking about ticks and trend and put call ratios and advanced decline lines as if all those stocks are important. They're not, right? If we had weighted internals, that would at least start to be interesting. But since internals are not weighted, I'm not worried about broader participation. We want to get very specific about what's helping a particular index or sector higher. So I would start with XLK, SMH, and I want to see XLK, SMH, and the NASDAQ move higher, because that's two of the heavily weighted sectors and the index that benefits the best. And then if you want to start to break down, what does that then mean? Is Apple still moving higher? Is Microsoft still moving higher? Is NVIDIA still moving higher? Is Taiwan Semi? You see where I'm coming from? We want to think about the components that are within those indices, within those sectors. We want to think about those most influential pieces, right? So as long as we know we're looking to the long side, right? Do I want to pick a top? There's a lot of folks that think, we could sell off in the middle of summer. Why? These are probably the same folks that told you to sell in May and go away, to be quite frank. So, think about it. Even a broken clock is right twice a day. So be careful with being too bearish here. There's no reason to be. Now, if you shorten the time frame, maybe there's some pullback plays to be had. That could be day trading, right? We could have a week session or two. Maybe today's one of them. Who knows? But please don't get longer term. Please don't get longer term bearish. It's been wrong pretty much all year. So eventually, right? Let's look how wrong it has been to be anything but long. Right? So now is the time. Shorten the time frame if you want to look to the short side. Shorten the time frame if you want to just say, Rag, I don't want to have to worry about what's going to happen tomorrow and the day after. That's a great risk management approach. But for the most part, I'm going to stick with the long side, and I'm going to try to be as patient as I can be to buy those dips so I have a better risk reward, better risk control. And that's all we'll continue to do. Rinse and repeat what we've done all year, because that's what the year has been doing. All right, gang. That's a wrap. Thank you as always for being here with Charts and Coffee. I'm always going to give it to you straight. Look, the broader conversation about the markets is about entertainment. You and I have to put money to work and then manage risk. And that is not what's happening on television. So be careful, right? They're two very different things. I will see you all tomorrow, same time, same station.